Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back. This is episode 191, Real Client Questions with Cory Bittner. Cory, thank you for joining back on the show.
Jake, thanks for having me. These are some of my favorite shows to record where we answer real client questions. So I'm glad to be here.
Yeah, and then from the feedback that I've been getting from clients, I think they can relate to them because they've either been the ones asking the questions and it's good for them to hear the answer again, or two, maybe they haven't asked the question or they've been thinking about it. So I think, we've taken basically real conversations that we've had with clients and we're putting them in podcast and video form so that our listeners, if they're thinking that, or maybe their advisor hasn't answered this question for them, they can get the answer today. Now, quick disclosure, this does not constitute financial advice, right? We can't give advice on a recorded show. It's just not that simple. It'd be like a doctor prescribing a prescription for everybody, right? It doesn't work that way. And so, but what I do want to do is I just want to talk about some of these real questions and ways that you and I have addressed them historically. And maybe that'll provide some context for the client to think about things a little bit differently.
Very good.
All right, very good. So let's dive into it here. So number one I got for you is, Cory, how much money do I need, or is what I have enough to retire on? How would you answer that question?
It depends.
Okay, that's the only time you get to say that this show.
I know.
But go ahead. How would you answer that question?
So it does depend. And it all comes down to lifestyle and spending needs. I have seen clients retire comfortably with $500,000 to $600,000, and I've seen other clients that have needed more, like $2 to $3 million, to retire comfortably. And it all comes down to how much debt someone does or doesn't have, what their cash flow needs in retirement are, and what their other cash flow other source of cash flow in retirement is, aside from just distributions from investments like Social Security, pension income, et cetera.
Right. And ultimately, it doesn't really matter relative. Like some people say, well, I heard that, you got to have 2 million or 1 million. And again, it all boils down to your lifestyle. Are you carrying debt into retirement? Well, you got to account for that. Are you going to need to buy health insurance? You need to account for that. Do you have a second home? Is travel? Some people don't do much, and there's nothing wrong with that. They love Kansas City. They don't travel much. Their kids and grandkids live here, and they don't need a lot to retire on, right? And we have other clients who are traveling the world and have a second or third home and mortgages and car payments and boats, right? And planes, right? So like you said, it's all relative. The beauty though is in the financial plan, we'll be able to show you exactly how much you need to retire. And then we'll project that out over your retirement career to show you if that's set up to be sustainable. Now, the important piece though, is these financial plans aren't static. It's important that you look at that, obviously, but then you want to update it and review it at least every year, because life changes, the market changes, your spending changes, and so forth. And so what might look good today might not look good 5 years from now, or might look better 5 years from now. So you got to review it, and don't get caught up in these 30-year projections that we show you, because they change every single day. I don't want you to, we've had clients in the past like pinpoint it down to the dollar, and it's like, life doesn't work that way. You can't look at your financial plan last year and be like, hey, Jake, you said when I was 90, I'd have 2.3 million. Now I'm going to have 2.2 million. What happened? Well, lots of things happen. Maybe you spent more money. Maybe the market didn't perform as expected, right? Or maybe your health insurance went up, right? Or whatever. So the key is to know kind of where you stand, what your lifestyle is going to look like, project that out, and then most importantly, review it.
Jake, you might have said this inadvertently, but you said retirement career. And I like that. I've never thought about your retirement can be another career for people.
It
I've
is.
never thought about it that way.
Yeah, I think I might have just came up with that.
Well done. You coined that.
All right, good. Good. Cory, why don't you throw the next question at me? We'll kind of ping pong it here back and forth. Or pickleball it. We'll pickleball it back and forth.
Pickleball it. All right. All right, Jake. Can I buy a second home?
Yeah, so I have a lot of clients debating that right now, literally right now. And I think they feel a little foolish because everyone tells them the housing market is in a bubble and that prices are too high and you shouldn't be buying a house right now. But I completely disagree with that general statement that if you're looking for a second home, and again, I'm not a real estate investor, but I don't look at real estate as an investment. I'm sure it's a diversifier in your overall net worth. But if you want to buy that house in Florida or Texas or Arizona, because you're going to take your grandkids down there, or you're going to winter in those months, the winter months down there, and you're going to create some memories. And another side note, it might actually be healthier to be able to do that because you'll get out and exercise and do more in a warmer climate. Then for our clients, if they can afford it, I'm all for it because, I've had conversations that if you're waiting for this housing bubble to burst, which may never burst, you may be waiting a decade. And if you're 60 years old, you might not pull the trigger on a Florida home until you're 70. Well, then are you going to be in the same health when you're 70? I don't know.
Right.
Are your grandkids even going to want to hang out with you in 10 years? Maybe not. Right. So I say, and this is probably rare, Cory, for a wealth advisor to say, I say, if you're retiring or not retired and you want to buy that second home, why are you waiting? If you can afford it and it works in the financial plan, then I think you need to consider it and not wait. Sure, you may overpay for a property, but if you're not doing it to flip the house and turn a profit, that's what we buy stocks and bonds for. Let's invest that way. And let's go buy a house to create memories in and maybe live a healthier lifestyle. If you can do it because you're going to live a healthier lifestyle, I'm all for that. What do you say?
That's good. I like that. And I like to hear you say that because I think about it the same way, Jake, in terms of, people want to do the smart thing. What the smart thing is today, will it be smart 10 years from now? We just don't know. But to your point, if it's not designed or intended to be an investment that you're going to hurry up and sell, buying a home, a first house or a second house, right? I mean, I think a lot of it comes down to the timeline. And I think if you pay more money for a house today and housing prices decline 2 or 3 years from now, if you're not in the position if you don't need to sell the house then, and you're able to use it for what the intention is, to be active, to be healthy, to spend time with family, et cetera, why wait?
Right. Good. Okay, good. Let me ask you the next one here. How about this one, Cory? When is the recession going to happen?
Good question.
How do you answer that one? Or is it going to happen, I guess? Is, and when will it happen?
The answer to is it going to happen is yes. It's always a matter of when, right? Because we understand the way the business cycle works, right? Expansions and contractions and recessions are part of the business cycle. So acknowledging and embracing that in a way, I think is a healthy thing to do, recognizing that those things do happen. But to answer your question about when will a recession happen, while I don't know, I can't see the future this year, next year, and beyond. There's a number of different people that debate this, but from everything that I've read and gathered, the expectation is with the labor force as strong as it is right now, despite inflation and everything else that we are seeing in the economy, the likelihood of a recession in 2022 is relatively low, but the possibility of a slowdown or a recession in 2023 is absolutely a possibility.
Right. And I think how I answer this is it's also important to not listen to your neighbor's brother's cousin's sister who claims they watched somebody on TV or got an email saying a recession is happening tomorrow and that you should sell all your stocks. Like that's not how this works. And technically, the definition of a recession is two consecutive quarters of negative GDP or gross domestic product. So we haven't even had one quarter. So you literally get 6 months before you realize you're in a recession. We haven't even had one negative quarter yet. So to your point, the earliest it could be is October, right? this year.
Right. Yeah, using that definition, absolutely.
And that's why your statement holds so much water. And so don't listen to your brother, sister's, cousin's, neighbor's mother, right? Don't listen to the financial press, right? And probably most important, if and when, like you mentioned, because cycles do happen, if we get into a recessionary environment, we have historically taken that as an opportunity to buy stocks. We're not going to sell your stocks in a recession. We're going to buy them because they're low. And you'll have all these people panicking out of the market, and all these stocks will go on sale. They'll be cheap, and we'll buy them up. And so I guess to answer the question, nobody really knows when a recession is going to happen, but we do know that it happens after 2 consecutive quarters of negative GDP. We think that may happen next year based on the economic environment as it holds today. And if and when it happens, we're not going to sell your stocks. We're going to buy stocks. And so we have a plan in place. We've seen them before, and we'll see them again, like you said, and things cycle. So good one.
And that's good. And I think the one other point I would like to make there, Jake, is that I sometimes think it's a challenge for people because sometimes investors, people who have money invested in the market, right? Clients, you, me, whomever it is, sometimes are at odds with themselves, right? Or have this internal conflict because people understand that timing the market consistently is virtually impossible to do.
Right.
So people understand that. But on the other hand, people also have the desire to say, well, if there's some type of, looming recession or downturn on the horizon, what if I timed the market and sidestepped that, right? I was able to avoid that. And I think those 2 things are just completely at odds with each other. But I think that sometimes people have a tendency to look at it that way. They know they're not supposed to sell stocks into a downturn, but there's also this idea or prospect, and maybe that's what makes it so enticing in a way when the financial networks and your neighbors, cousins, sisters, et cetera, talk about that is like, oh, well, if I can do the smart thing and I can sidestep this and avoid it because someone sees it coming, that'll be the right thing for me to do. But that completely counters the whole approach and strategy in the first place, which is not to try to time the market.
Right. Very good. So before I think it's your turn, right, to ask me the next question?
It is.
Quick commercial plug. Thank you all for tuning in. If you're not already subscribed to our YouTube channel, Falcon Wealth Advisors Collective, please do so. If you're listening to this on your favorite podcast platform, a thumbs up, 5-star rating is much appreciated. Cory, you got your own show called In the Money Insight. It's also out there in podcast land and on our YouTube channel. All right, Cory, let's hear it. We got one more, right?
On In the Money Insight, I'm very close to recording episode number 100.
Ooh.
Very exciting.
Ooh, are you going to do something special?
I haven't decided yet. I'm going to ask you to be my guest, though, Jake.
All right. I'm excited about that.
But
all right, we got 2 more. I got 2 more questions, right? So go ahead.
Yes, Jake. So this is a timely question based on what we were just talking about. Is the market going to crash?
Yes, we get this question a lot, and it's a fair question. We've got inflation running rampant, a recession looming, right? We've got a war with Russia and Ukraine, which is horrible. We've got a midterm election coming up. We got a tax bill that probably will get passed at some point this year. So we've got a lot of uncertainty in the air. The market's had a great run up despite COVID. So people are asking me, is the market going to crash? Should I be buying stocks right now? And the market crashes, and like you just mentioned, you can't time it correctly. So if you're trying to get in or out based on that assumption, it's a fool's game. You might as well go to the casino, Cory, because then you can get free drinks, right? Or a free hotel room. Yeah. But you do not want to be gambling your retirement nest egg. And this is very important for almost all of our clients. I mean, there might be a couple of exceptions, right? So I can't say that with definitive purposes, but we don't aim to put anything that our clients need in common stocks for 5 years. So meaning whatever money you have invested in the stock market, that is money or capital that we have earmarked for 5 years and beyond. So what the value of that piece of your portfolio does on a day-to-day basis, or if it crashes today or tomorrow, doesn't matter to your cash flow, which is the most important thing in retirement is cash flow. And so, in my opinion, and so you don't need to be concerned about that, right? And if you're working still and you're worried about a crash, well, that's just another buying opportunity. So the market crashes and you're working, you're just going to be buying more shares cheaper. Right, but I don't want you to get caught up because we had one. We had a crash in 2020. Market crashed 30% in 1 month. What did we do? We bought.
Stocks.
Right, we bought. We bought stocks, even for our retirees, even for our clients still working. We bought. Right, and it has been unfortunate, Cory. An interesting quick phenomenon is bonds have come down too because rates have gone up. Right, so you want to be careful with that. Bonds have come down, but not nearly as volatile as stocks. Yes, your bonds might be down, and you might need to sell some of those down. But generally speaking, they're not going to be as volatile, and they're still paying interest. So we want to make sure we've got, a cash pool, a bond pool, some preferred stocks, and some common stocks in there. And so again, common stocks are what most people think about when they think about the stock market. If they crash, just know we don't want your short-term money in that investment to begin with, and we will take that as a buying opportunity in there. But do I know if the market's going to? No, nobody does. Nobody knows if the market's going to crash. It could happen next week, right? But again, the risk, it's called risk premium. You get paid or rewarded by being able to stomach that risk and stay disciplined during those volatile times is why equity investors have historically been rewarded far more than gold or cash or bonds. Historically speaking, equity investors have been rewarded handsomely by staying invested through market crashes.
Yes, and you just dropped a lot of good nuggets of wisdom there, Jake. But I think that to just build on what you said in a few different ways. One would be recognizing that when you're investing in stocks and investing in companies, you are investing in people that are running companies that are providing goods or services, and you're investing in the future cash flows of those companies, right? So it's different than investing in gold or Bitcoin or something to that nature, where you're really doing it exclusively for the purpose of price appreciation. There's no cash flows, there's no dividends, et cetera. So that's an important delineation to make. Secondly, you talked about how we have clients' dollars invested for both the short term and the long term. I really do think that it is a helpful thing for people to embrace market cycles and to recognize that there will be downturns, there will be market crashes, there will be recessions. We have the expectation that those things will happen. But I think the more that people resist the idea that that happens, or resist the idea that those things are on the horizon or that's baked into their financial plan, the more difficult it makes the experience. So just recognizing that those things will happen, and we have money invested for clients with the expectation that they will.
Good.
And then the last piece that I just wanted to add was, again, I just think that generally speaking, I was reminded of this actually from a podcast that I recorded earlier this week about how, pessimism can almost be seductive at times, and how it feels like someone's trying to help you out when they tell you, hey, the market's going to crash, you better get out before it happens. It feels like someone's trying to help you out, but if we use hundreds of years of history as our guide, that would not have been the right thing to do prior to any other downturn.
Where'd you read that?
The Psychology of Money.
Yeah, because I feel like I've read that too before. And that's what's a shame, is that you have these negative Nellies sending emails on the news, your buddy's sister's mother telling you, oh, you better be careful or things are bad. Like, so people want to latch onto that because they're trying to save you, where the optimist guy gets shunned. Like the guy that says, hey, stocks go up over time, stay disciplined, that gets poo-pooed.
Yeah.
And these negative fear mongers get all the credit or get all the validation. It's like the interesting point, those people that have said that have historically been wrong time and time and time and time. Again, they always end up being wrong. Now, they'll be right the day the market crashes, but then they're not right in the fact that it recovers and goes up. So if they told you to get out, sure, you might have missed it, but then did they tell you to get back in? No. And you missed that bounce up. So don't pay attention to those negative Nellies.
Yeah, or just recognize that, optimism, people will shun that as being, like you said, Jake, idealistic or delusional.
Right.
But pessimism sounds like someone trying to help you out. But again, and I think it's just the nature of the news cycle and the information cycle in front of people today.
Right. All right, good. So we got time for one more question. This is a pretty common question here, especially lately for me. Where can I park some money to make interest, to make some money on it, without losing any money.
What is your time horizon for the dollars? Could you need them
Good
tomorrow?
question. So yeah, so they've got cash, and they're going to need the money this year to build a deck or buy a house or whatever. And so they've said, I've got some cash. I want to make some interest on it, but I'm gonna need that money this year, and I don't want to lose any. What do I do?
I would look at either a high yield savings account or very short term maturity bonds.
And do you get this question? I get this question a lot.
I do.
So what I've been telling people is check your checking account. I mean, yeah, I like a high yield savings if they want to go through the trouble of, and where do they find? They find those typically online, right? You got to be careful. Make sure it's a bank you've heard of, a reputable institution. The short-term bond, yeah, they're not going to make that much, right? What's a 2-year treasury note is yielding about 2%, but again, that's 2 years. So, so again, but I've been telling them, look, there's no risk without reward, or excuse me, there's no reward without risk. So I could take your money, right? I could take your $500,000 in cash and I can invest it, but it's going to be volatile. It's going to go up and down no matter what I put it in. So eventually, hopefully, we can start buying CDs again. Cory, have you ever bought a CD? You have, right? But not very many. Like,
no.
Early, way back in my career when I first started, I feel like you could get a 1-year CD and pay the client 5%. You know, that was 15 years ago. But and if those days happen, we'll do that, right? But today, like literally today, if somebody walked in my office and said, "Jake, I got 200 grand. I'm gonna need it in December," I'd probably just tell them, just keep it in your checking account. Because if you can't stomach the volatility or the potential to lose some of it, there's not much you can do right now. And that's okay, actually. It's okay. It's just the environment we're in. Now, the Fed is raising rates, and actually that'll help. So as the Fed raises rates, I would expect savings accounts, checking accounts, money markets, CDs, bonds to pay more. So that's coming. But today, there's not a lot you can do. And that's okay. Like I keep a good cash buffer personally because I need it, right? And I don't, and with I don't want to lose my mortgage, right? My mortgage payment. I don't want to risk my mortgage or my electric bill, right? So that stuff I leave in cash, but everything else I'm putting in stocks and whatnot because it's long-term. So you got to be okay with that, right? And it's okay. Like I get people, and again, I don't think it's coming from a place of greed. I think people are just want to be smart with their money. And a lot of them have like they've got $300,000 and they feel foolish leaving that in a checking account. To them, that feels foolish. But if you don't want to see it fluctuate and you know you're going to need it, it's okay. It's okay is what I'm telling you, generally speaking. Now, one quick caveat. If you don't think you'll need all of it, so let's say you've got 300 grand and you may only need 100,000. Well, you could always use margin or other lending capabilities, which again, margin is not something to take lightly. And I'm not recommending that here, but I'm just saying there are other avenues that you could explore that we can certainly talk about one-on-one, because margin is an opportunity, but it has its own set of risks. That should be a whole nother episode. So again, I'm not suggesting that necessarily, but if you don't think you're going to need all of it, then I would invest it. But if you know, Jake, I got 300 grand and I'm going to need 300,000 exactly, then you shouldn't be playing around with that. You should leave it in some sort of checking savings account, liquid.
Yep, that's very good. And I find, because I do get the question a lot, just like you did, and I find that, I don't know, maybe 9 times out of 10 when people ask that, my response will be aligned with yours, which is if you think you're going to need the money this year, it's just not worth the risk. And I think that 9 times out of 10 people are relieved and comforted to hear that, because they feel like they're doing something foolish, like you said, or something wrong, just leaving the money sitting there. And it's almost, people just need to hear that that's not the wrong thing to do if they're going to need that money, because it's just not worth the risk.
Right. Now, a couple of years ago, this is what's been unfortunate about the recent environment. A couple of years ago, we would invest that cash in some bonds and prefers, but with the Fed, with now inflation rampant and rates going up, it's not the same environment. So a couple of years ago, I probably would have answered that question differently, but we're here over the last 6 months. We're just in a different environment. It's just what it is.
I do though, Jake, I do think for clients, as rates move upward, I do think that for short-term cash, I do think that, high yield savings accounts are not an unreasonable place to look. Prior to I have one myself, prior to the pandemic, actually prior to the pandemic, before rates were so low, before rates were slashed down to zero, I remember that account paid around 2.5%. And that money was not invested. There was no risk. It was liquid, could pull the funds out. If the amount is sizable enough, 2 to 2.5% is something. But again, it's not going to change anyone's life, but it is something that it is an area to consider to earn more interest as rates move higher.
Right. And without plugging them, was that something you did online?
Mm-hmm.
Yeah.
With a very reputable company.
Right. Perfect. All right. Well, thank you, Cory. That's about all the time that we have for today. You got any personal you want to share? Any books, movies, shows, anything fun you and Cassie are doing?
You always ask me this question and I'm never ready to answer it. I don't know why that is. Not really. Cassie and I have started watching a new show. We've been watching Brooklyn Nine-Nine. That's pretty funny, lighthearted, good entertaining show. So that one's new.
Good. Yeah. I got this book.
Watching it and reading and listening to stuff.
Yeah, I'm finishing up this book right now. I love this book. This is really, really good. No Rules about the Netflix founder. It's really game changing. We're going to be incorporating a lot of their culture into our culture at Falcon Wealth Advisors. So I'm excited about that. I watched this stand-up comedian on Netflix the other day, Ronnie Chang. It's about an hour long. It's really funny. I thought I don't really watch a lot of stand-up comedy, but I just fell upon it. I thought it was pretty good. Yeah, it's golf season's here, so the majors are fast approaching, so that'll be fun. And getting over a little bit of a cold, so I'm excited for hopefully that to get cleared up here. So
and the Jayhawks are the national champions now. Crazy!
What a great March! Despite if you're a Kansas fan or not, if you're a college basketball fan, I thought it was a pretty well done March. I mean, we had some big time upsets. St. Peter's had a deep run, which was fun to watch. Yeah, I'm super happy for KU. My wife went to KU. I've always kind of rooted for them because growing up in West Texas, and my dad's from Kansas City, so he kind of liked the Jayhawks growing up, even though he didn't go to college there. But it was fun. I'm happy for them. They played great. They deserve to win. I mean, they played solid basketball. So
it's fun.
All right. Well, thank you again. Thank you, all of you, for tuning in, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.